Friday was really panicky, Dom, and I heard the same narrative on Friday afternoon. Obviously, we're late in September, which is not a good month for the market. Friday was just a pure risk-off market, without a doubt. So it's good to see. I mean, the market's down today. You would expect that. It would have been strange if it was up. But it does feel that everyone is incredibly negative for the right reason, by the way. I feel that for the first 7 months of the year, the majority of people felt that the Fed was kidding and that the Fed really wasn't serious and they really weren't going to do all of these rate hikes. Well, now we know they are not kidding and they're going to do these rate hikes. Whether we need them or not, they seem really dead set on continuing to do them for the next few months. So I think that it will come down to earnings, because to me, where I'm a big believer in not fighting the Fed, and I've talked about that all year long, but what's a little bit positive is 100% of the sell-off this year, Dom, has been multiple contraction. You know, earnings, albeit most of it was from energy, are still positive. And so I think everyone's expecting earnings to come down. And so we'll see what happens. But I do think it's constructive that earnings have been this resilient so far, and we're already towards the end of September.
You know, it's interesting, Jason, when we talk about Bryn's point here, multiple contraction is no doubt in play, but you could argue that it's legitimate, given the fact that we've seen risk-free rates, Treasury yields climb so much higher right now. It changes the calculus, right? If I can get risk-free money backed by the full faith and credit of the U.S. government and the U.S. taxpayer, yielding right now for two-year note yields, by the way, 4.29%, I maybe don't need to go as much or pay as much in the stock market right now. So to Bryn's point, multiples are in play, but how much of this in your mind is this expectation that earnings may come down, expectations in the next several months as we head towards the season?
Yeah, Dom, I think it's an important point. You know, if I look to earnings in the next couple of weeks and look at what's just transpired, as you've already mentioned, I mean, yields are on the run. You know, you have a two-year close to 4.3%. You know, this TINA trade that we've been talking about for a while now, you know, it is starting to slow down. I mean, there is opportunities in fixed income, you know, investment grade fixed income, I should say. So for me, though, you know, as we kind of look at the markets going forward, you know, obviously concern around the dollar. You know, the dollar's up 18% year to date. You know, there's obviously, as Bryn mentioned, you know, the Fed is resolute. They are very much engaged. You know, they made a decision on 75 basis points last week. They likely will continue to hike, you know, through the end of the year. You know, but the labor market is still strong. So it's a mixed bag. You know, as we move forward, we still remain relatively defensive, you know, with healthcare and energy being primary sectors that we like going forward. You know, but I do think there's an opportunity for fixed income. And as you kind of look at a balanced portfolio going forward, and I think that is something to make sure that you pay attention to. Stay patient in this market. You don't need to chase here. You know, there's still a lot of volatility ahead. So that's how we're looking at, you know, the markets going forward.
You know, Joe, to Jason's point, I mean, I'm looking right now at the yield, the dividend yield, so to speak, or the payout yield for high yield junk bond type ETFs, and they're now north of 5%. Mm-hmm. That's a lot higher than they were just a month or two ago. It makes sense as the prices have come down. But is this attractive? I mean, when you can, and I'm not talking investment grade, that what I was referring to is high yield. Investment grade and high yield are now both maybe more attractive instruments for income investors. So does that then mean that there is more downside in the market? Because I can find returns and payouts that are higher up on the capital structure than equity investors.
So, Dom, two different conversations that are unfortunately tied together by the direction of the market. Let's first take the investor approach to the market right now. The 60-40 portfolio during the course of 2022 has had one of its single worst years in decades. Right now, if you're looking for the value proposition and where it's presenting itself in that 40% allocation, whether it's investment grade, municipal bonds, or high yield. So that's a place, given the dislocations, that a long-term investor could gravitate towards right now. The unfortunate conversation right now in the market is directionally, we're trying to figure out, well, are we going to take out the June lows? Are we going to go back to the previous high before the pandemic at 33.93? Or are we potentially going to go down to 3,000? And Don, there's a lot of people that are communicating that to long-term investors. But the problem with that is the very same people that are communicating that, they're the ones that are telling you that's going to be a capitulation moment and that you're going to need to be fast enough because the market is not going to spend a lot of time down there. So I think what it's important to do for longer-term investors focusing on the 60% allocation in their portfolio, Fridays have been an ugly day during the course of a week. Over the next 8 weeks, the next 8 Fridays before Thanksgiving, put a little money into the equity market, assuming that you don't need cash. If you need cash in the interim, well, then you got to understand you've got challenges right now. The challenges are represented by the S&P, which has 68 new 52-week lows today. It's represented by the elevated volatility. It's represented by the fixed income market. And then certainly it's represented by the volatility in the currency market.